Welcome to our Taking Stock video for the week ending the 21st of July, 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and today I'm joined by our Senior Portfolio Manager, Matthew Swartz, to stream to you all things share markets. Great to have you on board again, Matt.
It's my pleasure, Kien, and it's great to be joining you again.
But before we get started, a quick yet important reminder, the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any charts or tables shouldn't be relied upon as a guide for future performance. So, Matt, we are now on the doorstep of the full year reporting season, and the earnings growth expectations for the market over the last financial year has been relatively flat. However, if we drill down into those sub-industries, we can really see the sectors that have weighed on the market. And the industries expected to post negative earnings growth for the last financial year are in energy, materials, media, and mining. And meanwhile, the strongest growth sectors has been technology and insurance. And what about looking into financial year 24, which is the outlook? And this will be the focus after the reporting season. Expectations are for the market to grow earnings by only about 3%. And if we drill down into those sectors for financial year 24, growth is expected to be strong across most segments, though, apart from the banks, energy, and retail.
And as you alluded to, Kien, it's reporting season, so we're going to learn a lot more when companies produce some guidance for FY24. But as we've been discussing as a risk for quite a few months now, we at Lincoln are concerned that analyst forecasts are a little bit too optimistic for FY24. And although revisions are starting to come down, we believe this trend may accelerate if the global economy does move in towards a recession. You can see that with this chart on screen here, that the black line has begun to trend down. And this line represents forward earnings expectations, and is comparing that to the All Ordinaries Index in blue.
It's an interesting chart there, Matt. Let's just drill into the market here as well, just to understand the reason for those downgrades. And the chart on screen shows the last 3 months earnings revisions, and that's split by individual sectors. So even though the chart looks very similar to the previous charts we show, remember, this one's about the earnings revisions over the last 3 months. And you can see earnings expectations across the banks have been revised lower after they reported an earlier than expected peak in their net interest margins in May.
And we've also seen earnings downgrades across the energy and mining sectors as the commodity price environment continues to weaken on the back of weakening demand dynamics predominantly in China. And in addition, the lagged impact of rising interest rates has materially impacted retail spending, as we all know. And we believe this thematic is at risk of continuing as we play out the remainder of this year.
Yeah, that's definitely going to feed into the rest of the other sectors in the economy. But despite these challenges, Matt, the economic climate has been surprisingly resilient. Just this week, the unemployment rate that was released remained quite steady at 3.5%. And this should help those banks control their bad debt expense, although this will cause labour wage pressures and will continue to suppress those profit margins. In turn, though, you've got those inflationary pressures. We expect them to linger for longer, especially the core inflation. And that means that we may not have reached the peak in the interest rate cycle. So from an investing standpoint, we cannot be too complacent.
Absolutely. Complacency can kill you in the share market. And unbelievably, we're trading close to record highs, but earnings risks and insolvency levels are also increasing. In fact, recent figures from ASIC revealed that 7,943 Australian companies fell into administration in FY23, and that was well up on the 4,912 reported in FY22. And with reporting season on our doorstep, it is an opportunity for everybody to reassess their portfolios and ensure that you don't have many exposures to financially unhealthy businesses. You've got to make sure that you set your alerts to inform you of any stocks that have experienced a deterioration in their financial health.
Yes, Matt, definitely very important. But another key theme we are closely monitoring this reporting season is the sustainability of those dividend yields, especially among the more vulnerable cyclical sectors. For example, resource companies like BHP and Rio Tinto, they are expected to pay bumper dividends, but they are also in the midst of a downturn in the resources cycle as well. So these companies have experienced negative earnings revisions on the back of falling commodity prices as China's economic growth slows down, Matt.
Yeah, and within their quarterly announcements, volumes were solid for both of the miners, particularly in the iron ore segments, which continue to dominate their proportion of earnings and cash flows. But we've begun to see other parts of the business struggle. BHP noted that costs within its coal division would likely be higher than expected, and Rio downgraded expectations for production within its copper division.
Yeah, so far those announcements seem okay from a dividend standpoint, but future cash flows really will depend on the iron ore price ultimately, Matt, because currently iron ore earnings are forecast to be about 74% of Rio's profits and 60% of BHP's profits.
And operating costs and capex requirements are increasing materially over the next few years. So overall, we do see potential risk for dividends to fall below expectations. And as such, we are watching these stocks closely and may remove them from our coverage if the slowdown in the commodity cycle accelerates.
Yeah, definitely our team will be watching this space, but among the resources, let's turn to the energy space. Australia's two largest oil and gas producers, we had Woodside Energy and also Santos. They released their second quarter result this week, and the share price reaction of both companies was rather muted as production volumes came roughly in line with market expectations.
And what caught my eye, however, was the significant dip in Woodside's free cash flow per share over FY23. Woodside has a sizable bucket of oil and gas opportunities that are vying for its investment capital, including the Scarborough, the Pluto Train 2, the Sangomar LNG projects. So plenty of projects that are, as I said, vying for capital. There are also $5 billion worth of new energy projects, which includes a mixture of liquid hydrogen and ammonia projects. All of these investments will see capex increase to about $6.5 billion in FY23, which is a notable step up from the $3 billion in FY22.
Wow, and that's why, the free cash flow is expected to dip this financial year, but it's also going to be below dividend forecasts. But looking at the balance sheet, we can see that there's still ample cash reserves to make up for the shortfall this year. However, we will continue to keep a close eye on this stock because earnings will ultimately be driven by where oil prices go over the next few months.
That they will. But now onto the corporate calendar. The calm before the storm. Star income stock Rio Tinto should report their half-year result next Thursday after market close. Additionally, Macquarie Group will hold their AGM next Wednesday.
Now for Under the Microscope. This week, we take a closer look at liquor retailer and hotel operator Endeavour Group. The company's share price fell by about 13% on Monday. Fortunately, though, investor sentiment recovered somewhat as the market digested the Victorian government's changes to electronic gaming machine, or abbreviated as EGM regulations. Key changes include pre-commitment limits to pokie machines, also mandatory carded play, and the implementation of mandatory closure periods from 4 a.m. to 10 a.m.
And in my viewpoint, Kien, this shouldn't have come as a huge shock for investors, as the Andrews government did flag gambling reforms during their election campaign. And the reforms announced seem sensible in nature. In fact, they only really bring Victorian gambling regulation in line with other states like South Australia and Queensland. But unlike South Australia and Queensland, the Victorian EGMs make up quite a large proportion of gaming revenue for Endeavour Group, representing about 37%. But it is to be noted, however, that the Victorian government has yet to provide an implementation timeline on the proposed regulatory changes. So we need more detail on timing before accurate earnings revisions can emerge.
Yes, Matt. As stated, Victoria currently has the highest revenue per machine nationwide, generating approximately about $85,000 in annualized revenue per machine. Now, just for reference, though, machines in New South Wales generate only around $66,000, and machines in Queensland generate around $70,000 in revenue. So, assuming that these rules leads Victoria to reduce its revenue per machine to decline by about 20% in line with other states, this would likely lead to approximately 6 to 7% decline in Endeavour's total earnings.
Okay, Kane. So the earnings sensitivity isn't as meaningful as maybe the share price reaction at the time was indicating, hence why it's probably rallied back. And given that these reforms tend to be slow moving in terms of their implementation, we don't expect FY24 earnings to be meaningfully impacted. In fact, the markets still expect earnings to remain quite positive over the next 12 months as the hotel segment continues to enjoy the post-COVID tailwinds of consumers spending more on travel and leisure.
Yeah, that's why we're not seeing that much earnings revisions flow through, Matt. But also the gross dividend yield of around about 5.3%. It appears sustainable for now, but our analysts are currently reviewing this stock, particularly on whether the yield is high enough to compensate investors for the heightened regulatory risks. So stay tuned for this. With the reporting season fast approaching, a useful question this week is, how can Stock Doctor help me keep track of stock announcements and updates? So with many companies set to report their results over the next few months, it can be difficult to keep track of everything. But Stock Doctor makes this easy. First and foremost, ensure that your portfolios are up to date within the Portfolio Manager. Then you can set up your alerts to monitor stock announcements and changes to the fundamentals.
And to set up these notifications, navigate to the Alert Manager under the Tools menu. And from here, you can create a new alert by entering in the company code and choose from a selection of categories, including star stock changes, financial health rating change, earnings revisions, price-sensitive announcements, days until ex-dividend, and technical triggers like SD30 TSR. Alerts can be processed intraday, and it will notify you within Stock Doctor or via email. It's up to you.
Yeah, good point, Matt. To make sure you have your email notifications turned on so that you receive the analyst email commentaries as well. But aside from the Alert Manager, there is the Corporate Calendar, which provides a window into what stocks are reporting over the next month. Here you can access report dates, the AGM dates, and also ex-dividend dates. Just be careful here. If there is an asterisk next to the stock code, it means that the date has not been confirmed. So it's only estimated by our system. Also in this section, the menu on the left includes options to filter on companies, watch lists, and event types as well.
And at the individual stock level, you can also access the upcoming corporate events by clicking on the date item at the top of the 9 Golden Rules page. Here, you can also see a list of alerts and whether this stock is in your watch list or portfolio.
And last but not least, reporting season is when really our financial health model shines. And it allows our members to quickly conduct due diligence on a company after the release of its results. No other financial health model out there has been back-tested with a 96% success rate in helping investors avoid corporate failure.
These two tools will help you stay on top of your portfolio during reporting season. And as always, feel free to contact us if you need any further assistance. Also, be mindful that the research team will be extra busy analysing all the results, but we will endeavour to return your phone calls in a timely manner.
Yeah, good point. It will be very busy for our analyst team. And Matt, that's all we have time for today. Thanks for your insights.
My pleasure, Ken. Thanks for having me.
And if you have questions with today's episode, feel free to participate in our Lincoln Live webinar this Monday. Also, this week, Tim has released part 1 of a 4-month education series, including the white papers on mastering exit and entry strategies. So feel free to watch and review and pass them on to your family and friends. Also, Tim's quarterly message is out for those who have not had a chance to read it. To summarize today's video, with the reporting season fast approaching, it's an ideal time to reassess your portfolio to make sure you are not exposed to financially unhealthy businesses. And Stock Doctor's suite of tools, including the Corporate Calendar, Alerts, and Portfolio Manager, makes it easy for you to monitor the stocks. Have a happy, healthy, and prosperous week, everyone.